Hello, and welcome to Hub International's ERISA 101 training webinar series. This series is designed for employers and others who want to understand ERISA's basic obligations. I will be your presenter today. My name is Jack McStravock, and I'm the Chief Compliance Officer for Hub International. Please be sure to review all the sections of this ERISA 101 training webinar series. They are available on hubinternational.com. In this section, we will be covering what is an ERISA plan. What plans are subject to ERISA? Well, ERISA applies to any employee benefit plan broadly defined under ERISA Section 3.3. It includes retirement plans, but this presentation will focus on health and welfare benefit plans. When we break down the definition of ERISA, we recognize that it's a plan, fund, or program that is established or maintained by an employer or employee organization, typically a union, or both, and provides participants and beneficiaries specified benefits through an insurance policy, self-funded arrangement, or under similar funding structures. There are a number of ERISA exemptions. For example, government, tribal, and church plans are exempt from ERISA. Commercial enterprises of Native American Alaskan tribes are subject to ERISA. Workers' compensation plans are exempt from ERISA. Unemployment compensation and plans maintained outside the United States for non-resident aliens are exempt from ERISA. There are also payroll exemptions. Not covered under ERISA are wages, overtime pay, shift premiums, holiday or weekend premiums. Also not covered by ERISA are sick pay or vacation pay, holiday pay, jury duty, and similar non-work-related pay schemes. How do we know if an ERISA plan exists? Well, an ERISA plan exists when the employer expresses intended benefits, intended beneficiaries, and a source of financing, and a procedure to apply for and collect benefits. What is a plan? Generally, anything showing that an employer contributes to benefit coverages or the administration of those coverages is enough. When courts look at this issue, judges have tend to lean towards an expansive definition of a plan. Facts are analyzed. Even a single payment may invoke protections under ERISA. What typical types of plans are subject to ERISA? Well, as you can imagine, medical, dental, vision, life insurance, LTD and STD, and some telemedicine plans. Plans that are not subject to ERISA include cafeteria plans or premium-only plans, Section 125 plans, dependent care assistance programs, bonus compensation plans, health savings accounts, transportation fringe benefits, and stop-loss contracts. Some plans, which may not appear to be ERISA plans, may in fact be ERISA plans. They include severance plans and voluntary group and individual products. Some of you may have been startled when I mentioned that voluntary benefit programs may be subject to ERISA. Voluntary benefit programs can be exempt from ERISA so long as there's no employer contribution to the benefit. Employees must pay all of the cost of enrollment in the benefit. The employee's participation in the voluntary benefit must be completely voluntary. The employer shall not provide any endorsement, marketing, or education for employees seeking to enroll in the benefit plan. The employer must require that the insurer publicizes the program to employees or members. Other than collecting premium through payroll, the employer must not provide an endorsement of the benefit. The employer must also not receive any compensation or profit of any kind for the program other than reasonable compensation for administrative services actually rendered in connection with the payroll deductions or dues checkoff. Sticking with the subject of voluntary benefits, we mentioned that an employer cannot endorse the voluntary benefit program, lest it potentially be subject to ERISA. So what is an endorsement? Endorsements include selecting the insurance carrier and/or the coverages or plans, negotiating the plan terms, linking coverage to employee status, using employer's name associated with the benefit being offered, recommending the plan to employees, stating that ERISA applies, or doing anything more than payroll deductions. For example, if an employer allows employees to use the cafeteria plan to pay for voluntary benefit deductions on a pre-tax basis, that's considered an endorsement. Also, assisting employees with the adjudication of claims or disputes is also evidence of an employer's endorsement of the voluntary benefit being offered and can subject the plan to ERISA. Remaining on the subject of voluntary benefits, a few slides back we mentioned that an employer may not publicize the voluntary benefit program, lest it could be subject to ERISA. The employer may allow the carrier to conduct insurance presentations in the workplace, act as an intermediary between the employees and the carrier or broker, inform the employees of the availability of the program, and provide employee information to the carrier. They can also set and track employee eligibility and maintain records. Beyond that, the employer should not tell the employees that it has arranged for the voluntary plan, endorse or recommend the program, paternalistically coach employees about the plan. It's much wiser to direct employees' questions to the vendor or carrier or broker. The general lesson here is that an employer should pick a path and follow rules. If the benefit is intended to be an ERISA plan, treat it accordingly. Does it fall under one of the safe harbors or exceptions to ERISA? Plan and communicate the benefit accordingly. There are a number of relevant entities associated with an ERISA plan. First, we have the ERISA plan itself, which is a contract that operates between the plan sponsor and the participants. The plan sponsor is the employer themselves. They establish, maintain, amend, and terminate the plans as they see appropriate. The plan administrator, on the other hand, is appointed by the plan sponsor and is responsible for compliance obligations under ERISA. For example, running or administering the plan, reporting details about the plan, for example, on a 5500. They're also responsible for interacting with the TPA, who may be delegated the responsibilities to administer the plan. A plan administrator is also a named fiduciary. A fiduciary has a duty of loyalty or a duty to work in the best interest of the participants and the beneficiaries covered under the plan. And then, of course, you have an insurance company, or HMO, or TPA, that act to administer the plan from the claims side. The other important entities that are associated with an ERISA plan are the participants and beneficiaries. These are the individuals who enjoy the full benefit that are offered by the employer or plan sponsor under the plan. They include employees or former employees and their beneficiaries, their spouses and dependents. When you include additional eligibility criteria for members of the board of directors, independent contractors, household help, or vendors that do work for the company, you're by default creating a multi-employer welfare arrangement. And there are many concerns and considerations to think about when you add eligibility for non-employees. Thank you for viewing this ERISA 101 training webinar, and particularly this section. For more information on this topic, please watch the other sections of our training webinar on ERISA. You can also go to hubinternational.com, scroll to the bottom of the page, and click on Compliance Bulletins for more information. Thank you, and have a great day.